The stock market is capturing attention as equity valuations soar to levels that seem out of sync with the actual earnings growth of companies. The S&P 500's price-to-earnings ratio is now approaching 30, a figure rarely seen in history and often viewed as a warning sign for potential corrections ahead. This means that while stock prices keep climbing, the profits of the companies behind them aren't growing at the same pace, raising eyebrows among analysts and investors alike. What's making this situation even more complex is the stability of Treasury yields, which remain steady despite the rally in stocks. At the same time, inflation trends are uncertain, adding another layer of unpredictability to the market environment. These factors together are creating a landscape where optimism is mixed with caution, especially as investors try to make sense of what's driving prices higher. All eyes are now on the Federal Reserve, whose decisions on interest rates could significantly impact the direction of the market. Investors are eagerly anticipating possible rate cuts, hoping that cheaper borrowing costs will help sustain the momentum in equities. However, the prospect of lower rates isn't enough to erase concerns about the high valuations currently seen across the stock market. With the outlook for the rest of 2025 described as cautious, many are questioning whether the current pace can be maintained without a correction. Business leaders and market watchers warn that the disconnect between soaring valuations and modest earnings growth could eventually test the market's resilience and sustainability.